Let's bring in Jerry Klein, joining us from Treasury Partners, Managing Director. He's got those rate hikes and Fed plans on his mind. Jerry, good afternoon. We've got the Jackson Hole Symposium later this week. Bonds are selling off again. Dollar looks like it's going to break out. What kind of pressure does that put on Jay Powell?
Oliver, how are you today? I think in terms of Jay Powell, inflation is clearly his number one priority, and the strong labor market continues to give him the ability to act upon that priority and try to tighten policy while there's strength in the economy and get this inflation under control. Overall, though, that's really creating a great environment for corporate cash investors to earn very strong returns on their cash without taking credit risk.
So is that a trade then? Can we trade this kind of gap between the market and the Fed? Is their job to close the gap, or is it the markets? Because there's been a bit of divergence here, at least if we interpret the stock rally to be about a dovish Fed. Does that mean we short stocks as Powell confirms that, hey, we're not messing around?
Well, I think the Fed is clearly on a trajectory to continue to tighten in the near term, try to get the inflation to moderate and hopefully continue to come down over the next few quarters. The uncertainty certainly lies further out in terms of Fed action in 2023 and beyond. For our clients who are predominantly publicly traded companies, this is creating an opportunity for them to generate meaningful interest income on corporate cash again, where they can generate 3 to 4% returns on relatively short duration portfolios that a year ago were earning less than half of 1%.
Is there a level at which bonds serve a function of income that makes them appealing? Is that what you're hinting at here, Jerry? I mean, are there going to be pension managers who are frothing at the mouth at 3%? Does it suck away from demand for riskier assets at 3%? Is that a level now that's juicy?
I think for our clients, this is extremely attractive. We look back over the past 15 years, and there's really only been a couple of opportunities for companies to earn 3 to 4% type returns on corporate cash. So, yes, I think it's a great opportunity for our clients. You know, 1 year ago when we spoke, Oliver, we were talking about Bitcoin as a corporate cash investment, which our clients were never interested in, but it's down over 50%. And here today, companies can go and earn over 3% just buying treasuries or close to 4% buying very strong investment grade corporate bonds.
So the diversification experiment of Bitcoin hasn't been going very well. Gold's not working so much either. So if you're okay with getting the 3% and maybe bonds give you something here, what about the rest of the portfolio, Jerry? What do we do if these other diversified, uncorrelated things that get pitched to us? We see the commercials. We hear the guys on Twitter saying it's going to be gold, it's going to be Bitcoin. It seems like our options are running pretty low here on what actually works.
Well, our clients tend to be very conservative corporate cash investors, and we stick to tried and true principles where we want to maintain principal preservation and liquidity while generating interest income. So for some of these companies, it might mean just staying in institutional money markets where today they're getting just over 2%. For others who can take just even a little bit of duration and ladder out, they have that 3 to 4% option if they can extend out on the curve. For some of these companies, that's not optimal, as they might be more acquisitive and want to maintain that liquidity. But many of these companies can segment out a portion of their cash and drive higher income on their balance sheet.
Okay. Jerry, what about for the stock side? Do we give up hope if this market's unable to plug to new highs? What about the passive investor who still has most of their assets sitting in a long equity indexed fund?
Well, Oliver, I really focus on the corporate cash segment of our client base, but I think overall this is definitely a time to be cautious. I think we're coming out of a period that was incredibly optimal for equity investors, where the Fed had everybody's back, and there's a lot of uncertainty in the market today. So we are definitely exercising caution when it comes to the equity markets.
But not shorting, not betting against it necessarily?
We're not betting against it, but we're certainly, I think, much more cautious than we were a year ago or 2 years ago in terms of our allocations and where in the equity markets we're invested today.
So if that means higher cash levels, Jerry, what about putting the cash to work in all these funds these days that have specific ideas that bet inverse to stocks or inverse to bonds? There's so many ETFs where we can bet against the market. Do we have to have an up market to make money, or can everyday people figure out a way to navigate a downtrending market?
I think in terms of the fixed income markets and funds, it is an opportune time for fixed income investors. For some investors, that might mean separately managed portfolios of fixed income securities, and others short to intermediate term durations in bond funds potentially can work. We still think you need to exercise caution in terms of longer duration bond investments in today's environment.
Okay. Jerry, thanks for the conversation. Great start to our show.
My pleasure. Thank you, Oliver.
Absolutely. Jerry Klein's Managing Director at Treasury Partners.